Your next guest expects the market to have another winning year. Sort of. Because parts of the market are going to do a lot better than other parts. Let's dive into the parts and find the tasty bits. Adam Parker is the CEO of Triverite Research. He was, of course, the chief U.S. equity strategist at Morgan Stanley. We're happy to have him back on Fast Money. Adam, you listened to our conversation just now. What did we miss? What are we missing, maybe, if anything, about this macro market?
Yeah, look, I'm optimistic on U.S. equities. The way I look at it, Brian, is, earnings will probably be around I think the consensus is $223 in S&P earnings next year, which means about 21 times forward earnings. Even if the numbers are a little bit too high, 21, 22 times, I think that's pretty attractive risk reward for a market that offers, 1.5% dividend, maybe a 1% net buyback, and then on top of that, some organic earnings growth. So I think the risk reward's pretty good for equities. I've probably been bullish for most of the last decade, and I just try to focus on what could really derail the earnings outlook. I think that's the real risk to focus on.
Yeah, okay, so earnings then. We've heard about the Fed. We talked about bond yields. We can do, I guess, Dow theory, Adam, if you want to do that. How much does a 1.5% or even 1.75 if it goes up yield play into that? We talk about earnings yield all the time as well. Does the 10-year note matter to your earnings forecast at all?
I mean, obviously it impacts the, companies directly there that borrow and lend and capitalize on the spread, the banking sector, insurance, select services, payrolls, et cetera. I generally am of the mindset, though, that higher yields mean the economy's strong. And when the economy's strong, corporate earnings tend to grow. So I don't really like the logic that we're anywhere near some tipping point where higher yields would, foul up the earnings outlook. I think when you want to call a market top, you should focus on two things: hubris and debt. Hubris meaning management arrogance gone awry, right? Too much capital spending, too much hiring, too much inventory, hiring too many fancy MBAs at the top of the cycle, those kind of things. So when I really look through the market, I don't see a lot of excess in that regard. I think the key thing to focus on will be in areas like semiconductors and industrials, backlogs and book to bill. Backlogs basically are, hey, I've been short product, I can't produce because of supply chain issues. Let me order more out in the backlog in the future. And at some point, those numbers in the backlog won't be real. And I think that'll be, a cautionary tale in those sectors of the market. Book to bill is how much did I ship versus how much did I just get ordered. And we've seen those numbers generally go from 1.5 to 1.08 to maybe 106. So we're still not quite producing at consumption in most of the, kind of cyclical areas in industrials and semiconductors. I think when we get to that point next year, then we have to, kind of look more cautiously at where earnings expectations are more achievable. What the panel said earlier, I totally agree with, is it's always a barbell within the U.S. equity market, right? You're always trying to find attractive risk reward based on estimate achievability. And so a lot of our work focuses on, hey, where do we think the estimates are more achievable? Energy and materials. Where are they less achievable? Industrials. Maybe more achievable consumer services, maybe less achievable in staples. Those kind of pair trades always make sense to try to beat the overall market.
Adam, it's Tim. Thanks for joining us. Where do corporate profits need to be fearful about inflation and margin squeeze? Because ultimately, I think that hasn't really been priced in, and corporate profits have been really running with excess margin.
Yeah, I think the area I'm most worried about is machinery and capital goods, where you've seen some of the industrial economic activity roll over a little bit, industrial production and others. I think people got a little too optimistic about maybe the infrastructure bill impacting these companies in the near term. And so you have a lot of companies that have record margins and are forecasted to have record margins even above and beyond there. And they're probably subject to logistics and transportation costs, materials costs, labor shortages, et cetera. So I think, machinery and capital goods are probably the most susceptible. I do like the point you guys made earlier about some tech companies that have pricing power. I don't like the profitless software companies don't make sense to me. But I think about this a lot in my own small business. Who do I pay, right? I pay Salesforce.com for my client relationships. I pay ADP for payroll, United Health for healthcare. I pay Microsoft for Azure compute and storage. I pay SPGI for data. All those guys have pricing power over me, right? So I could see lots of areas in the market where they have pricing power, and that's the part of the barbell I would take along with energy and energy and materials, and I avoid industrials and staples and REITs that look riskier or more expensive or embedding too much of a recovery relative to what I think is reasonable.
watching the energy, watching the industrials, all the things that are sort of in that supply chain, as well as Adam Parker's own company supply chain. And by the way, Adam, I think I owe you an apology. I was thinking too much of my high school French. I Frenched up your name.
Yeah, it's Trivariate. Just
I called it
variables.
Triverite.
Yeah, it sounded fancy. I liked it. Yeah, but it just stands for 3 variables, quant, macro, and fundamental, where I spend a lot of my background. I'll focus on equities. It's all right. I'll take it.
Well, je désolé. I apologize for the chunking. Adam Parker, thank you. Appreciate it.
Merry Christmas, guys.
Happy
Take
holidays.
care.
Happy New Year. Merry Christmas as well. All right, Steve Grasso, let's go to you now. You heard what he had to say. Are you a believer in sort of the real stuff? the energy stocks, the industrial stocks, the stuff, the companies you pay.
Yeah. Yeah, but here's the problem, though, and I agree with him on everything that he had said. So I have a significant portion of my portfolio in value names, and those are in chemical names or paper or container packaging companies. The problem, though, is if rates do not rise, Brian, and you touched on this a little bit with the 10-year, if the 10-year stays flat, that value bucket is going to be worth less. People keep running into those 4 to 6 to 8 names in the tech complex because it's the only ones they know of. They don't know the mid-cap value names. So I think he's going to be right, but I think you need the large cap tech to make people feel comfortable, pulls the whole market up, and then you can get a little bit of rotation, because if you look at the NASDAQ and the S&P, they look fabulous. You look at the Russell 2000, different story.